Welcome everybody. This is the Saturday morning Viper trading webinar. If you're here to learn about trading futures markets using the Viper tools, you are absolutely in the right place. Let's knock out our standard disclaimer so we can get on to the charts and start looking at some trade setups. Today's topic is detailed trade entries. Should be a good one. All communications from Viper Trading Systems are for educational purposes only. Futures trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live trading room, are to be construed as investment or trading advice. And of course, everybody in here does know that you do trade at your own sole discretion. All right, without further ado, let's get on to some charts. I'm going to start this morning with gold. We're going to work our way through crude oil and E-mini ES, the E-mini S&P futures. I see quite a few new faces that are still visiting us from this week. We are connected to a data feed to our broker, NinjaTrader. We are running on exclusively on the NinjaTrader platform. These charts are generated through Ninja. This is a 4-range chart. We do not trade time-based charts. We find that minute, 30-second, 5-minute, whatever, artificially misconstrue the price action. We like the consistency of 4-range. We've used that for 10 years. The colors that you see on the screen here, the background colors, bar colors, the swing levels, power meters, those will load in a minute. Data feed's still coming in here. Predictors, real-time support and resistance. These are all indicators developed by and produced and released by us, Viper Trading Systems. And this is what we teach on how to trade. And of course, you can see the most prominent feature on the chart is the bands. So we have this notion of the mid band, which is the large band in the middle here, and then there are 4 bands above it, 4 bands below it. Top of band 2 is called line 2, the thin red line. Top of band 6 is called line 6, the thin green line you see right here, stair-stepping down. Markets, as you know, can do 3 things. They are as follows. Markets can go sideways, which by definition is the lack of a trend, so you can get some chop in markets. We all know that. If you've traded any kind of instrument, whether it be stocks or Forex or futures, this is a pretty universal concept. Markets can go sideways, they can go up, and they can go down. I'm not going to get into a lot of detail about how to figure out whether it's going up and down. We've covered that extensively in other webinars. I want to zero right in on detailed trade entries, because that seems to be the bugaboo that most people want to take down, is exactly how and where to get in. Now, on the short side and on the long side, I'm going to focus on 3 trade entries today, but mainly I'm going to start with the mid-band. Let's get right into it. So when we say a mid-band trade, and you hear this in the live room, what does that mean? Well, I'm going to show it as simply as possible. This is the mid-band, of course, this thick line in the middle of the 8 bands, right? And so when you have bars that sit directly on it in what is called a retracement, when you have a trend, there is a notion of what's called the thrust in the trend direction. In the case of a downtrend, of course, that's down. Background turns red. All the bands stair step down. Bars are predominantly red. And we get a downtrending or a sell-off. Sell programs are in control. Now, a mid-band trade is where a market has thrust in a trend direction, in this case down, and then it retraces back to the thick middle band. Now, you're going to notice here with these candles that they can also go into the band just below the middle band, or mid-band, right here. And they can also go just slightly above it into the band, just slightly above the mid-band right here. So just to be clear, when we say a mid-band trade, or to take a mid-band trade on a retracement, in this case short, right? It can be in any one of these 3 areas. This area is defined as a mid-band trade. Now, let's talk about how you take this. Let's blow this up in excruciating detail, because this seems to be the area where everybody struggles quite a bit. Now, quick show of hands, how many of you use the Object Trader semi-automated tool that we have? Anybody? Object Trader, OT? Anybody OT users here? Yes? Quite a few. I use OT. I don't use OT. OT all the way. For those of you that are new, and you've seen this on Gary's charts extensively, I don't have it loaded here because I'm not. The purposes of this is not to cover how to use OT Object Trader, but essentially it is a panel that sits over here. It looks somewhat like Chart Trader. If you've used Chart Trader, there are some similarities, but it has a lot more functionality to it. But it's a panel that sits on the right-hand side over here. And the most basic type of trade is what we call a region box. So the whole idea behind Object Trader when it was developed was that we could actually, truth be told, let me go back over here. Let me explain what the original intent was. Can you see this range over here? When Gary and I first conceived of Object Trader, and this is not, it's got to be what, 2, 3, maybe even 4 years ago now. It's been out for quite some time, this tool. Was that we wanted to be able to take a large region box, engulf a range like this, and then set it up such that it would take trades at the tops and bottoms of the range. Because we felt that range-bound trading was challenging and tough and difficult, and a lot of traders really struggle with that. We struggle with it, and we wanted to be able to take just sort of a large box, if you will, or rectangle, and engulf the whole region, and then allow it to, take profits or short the top of the range, buy or cover shorts at the bottom of the range by simply engulfing it with a large box like such. That was the original concept when it was being developed and designed and built and coded. But as we started to work with it more, what we realized was that it has other uses that can be as good or better than trading the range itself. And what it was that when markets come up around this middle band area, that we could use much smaller region boxes to engulf those candles and then allow it to take trades. So for instance, let's discuss this retracement right here. Now, the most challenging part of taking entries, any system you use, and Lord knows I've seen over 25 years of trading, I've seen almost every kind of entry trading mechanism you can find, is to find out exactly where you want to get in. Now, notice right here, I'm going to show you something. You can notice that in a retracement here that the bars will go up, and then in the case of a downtrend where they are trying to find resistance to, as we say, kiss and roll over. And just conceptually what's happening here is that, and I'm not going to ask a lot of questions. I'm going to just sort of spell this out for everybody so we get a good understanding of what's happening here. So all market participants who were short from higher levels in the market, they could be short from beyond this chart, way up higher levels. Market participants are short. Sell programs have taken positions in the short condition in the short. And so in order to take profits, short covering must occur. So you get the final thrust here of the sell programs pushing a market down. And then as they begin to take profits, short covering creates an updraft, which pushes the market back up. Now, excuse me, before the selling can resume, there will reach an equilibrium where the profit taking of the short coverers, which is occurring right here, and the pressure to sell the market again begins to take over, as you see right here. This is the sell programs re-engaging and taking over the market again, along with other market participants. So it's our goal, in the case of taking a short trade entry, is to find this equilibrium. You can clearly see that it occurred right here. Now, what I like to do, if it's possible, is I like to see at least 2 or 3 or more bars that form a swing level to the upside and to the downside. Now, in the case of the upside, we have an indicator that helps you see it, and it's this one right here. So when the wick of this doji candle formed and these lines started to form right here, you can see very clearly that none of these candles were able to go beyond it. And thus we have the top of what will become our box, our region box to take a short trade. So the beginning of our box starts here, right here. Now I'm just gonna draw part of a box right now. Okay. Now, where might we put the bottom of the box? Well, let me give you some areas to think about, and I'll use a line. Could we put it somewhere in this area right here? At the bottom of the wick of this candle, which also corresponds with the bottom of that candle? Should we put it at the bottom of this candle? Or maybe this candle? Or how about over here? Should we put it over here? Now, it's important to know where we're going to put the bottom of the box on the short trade, because when the bar closes outside of it, that is when a market order is fired off and we are filled short. So in the case of the short trade, the location of the upper part of the box is not as important because we're not getting long. We've not enabled long, so it doesn't really matter. The bars can go higher up into here, and we can rebox it and take the short higher. So we're not getting long. The top of the box is really not that important, although you do need to have a place to put it. I like to see when you have at least 2 or 3 or more candles that have formed a little shelf area, as you see with this bar right here, and as you see with this bar right here. In my view, the optimal location for the bottom of your box would be connecting the bottom of those 2 candles right there like such. So your region box to engulf this area might look something like this, using Object Trader. Now, you might say, Charles, are there other ways to get in? Do I need to use the region box? The answer is, of course, yes. Let me just check something real quick here. I want to make sure I'm in Sim. I know the markets are closed, but I can show other ways to get in here. Yeah, okay, I'm in Sim. Not that it would matter. Markets aren't even open. In a pinch, let's say that you didn't have Object Trader, or you were installing Object Trader, or you're learning how to use whatever your reasoning is. Could you simply right-click here and put a sell limit order in below the location of the support level to take the short? Yes. Now, we recommend that you try to do at least 2 contracts. Now, this is especially helpful if you're using the micro minis, because they're only 1/10 of the value and 1/10 of the commission. So the 2 lot is not going to hurt you that much. Like I said, on ES, you're looking at 2 times $1.25, $2.50 a tick. You know, what are you going to lose on a 10-tick stop? $20, $25? So it's a good way to learn using multiple contracts. And I'll explain why we do that in just a second. First, I want to pause. This is a good example of a sort of a textbook region box taking a short at the mid-band. Are there any questions on this? Name what indicator, Phil? The one that does these lines? I think that's a swing indicator. It's on our template. The one that forms the lines at the swing here at 85.40. Yeah, that's part of the template. Yes, there is. We have this Object Trader alert. Let me see if market's closed. I don't know if it's going to flash or not. Let me check this out real quick. Is it going to flash? I don't know. Yeah, markets are closed. Yeah, of course. We have these alerts. Yeah, and that's a good point. Who said that? Bernie. Yeah, we have this alert now. So in the case of the short, you would toggle on the short alert indicator, and as these bars were forming, they would flash. Yes, and that's the extreme advantage of the alerts, is that you get the flashing there, you get to use the box, you get to put the limit sell order in there. You know it's time to get short. This is a continuation trade short, yes. Yeah, you're in a downtrend, so you're taking a short. But does everybody see how the logic? Now, some people say, hey, can I put a sell limit order here right at the midband? The answer is yes. Is that a superior entry to a break? The break would occur on this bar right here. If you drew the box exactly like I had it, what happens physically in the market, that object trader, the tool, fires a market sell order at the close of that bar below the box, and you are filled short. Let's say you have 2-lot on, you're filled short. Now, you can see here that if you put the sell order in at the midband itself, you have a superior fill in the fact that now you're filled at 85.10, whereas this trader here is not filled until 84.50, a clear 5 to 6 tick difference in the entry. However, if you put a sell order right at the midband, what are the risks associated with that? Anybody? What might be the risks associated with selling the midband itself before we have a continuation of the downtrend here? Do you see any inherent risks of doing that? By just putting a sell order right here and getting filled 5, 6 ticks above where it breaks right here? I mean, we know the advantages. It's a better fill, no question about it. I'll give you that, right? What would be a disadvantage of getting filled at the higher level? It can reverse on you. It could blow right through it. You might not get follow through. It might just stop you out. How do we prevent that? If you say, well, Charles, I really prefer the superior entry here at the midband, I want to short it up here. What might you be able to do to protect yourself in the event that you get something like this? Let's do a hypothetical. Just go ahead and you get like a bar or two break like this, bip, bip. So you're in the money a little bit, right? And then all of a sudden, boom, some kind of tweet comes in and then the market just takes off like that. Very tight stop, PW. Good. So what I'm saying is, I want to be clear. We're not saying don't take this. You can. You can absolutely sell the midband. But what you want to do is you're going to put your initial stop on your 1 or 2 lot, whatever how many you're putting on there, extremely tight right here. I mean, I would just go literally a tick or two above that swing area right there. So you're looking at your risk of 85.10 to an 85.50, 85.40 stop. So you're literally risking 3 or 4 ticks. Tight stop and only dip the toe. You could do that. That's a good point, Walter. The other thing is if you wanted to eventually get into a 2-lot total entry for yourself. Let me see if I can find a way to show this a little better here. You could sell one at or just a tick below the midband itself for your initial entry, and then go ahead and put another sell limit order, or use the region box to get into to a break here. So your blended average on the sell would be right here in the middle on the 2-lot. Of course, you would put a 2-lot stop up here then. So you'd put a buy to cover. Say hypothetically you're filled on both. Now you have to buy to cover on your 2-lot up here. Yeah, with an extremely tight stop. So that's how you would protect yourself. Now, a lot of that depends on the instrument. You know, ES is a slower moving, easier to track instrument that, you know, doesn't normally get a lot of spikes up and down. It tends to respect support and resistance levels. You can put these sell and stops in, and it's not going to whack you around the head and shoulders. Other instruments like the Russell and NASDAQ, they can flip-flop around, and you can get whack-a-mole here by doing what I'm showing right here. Not recommended on instruments like YM and Russell. Okay, so everybody sees how we get in. Now, the advantage of using the object trader tool is that it's in the fact that it's semi-automated and automated, that it will put the targets and stops in and manage the trail stops. If you use limit orders like this, you have to manage it yourself. So you have to put your targets in, put your stops in, trail the stops yourself manually. So why do we do 2-lot? Why do we recommend that you try to do at least 2-lot? Why? What's the reasoning behind that? Why don't we just say, hey, you know, you're adverse to risk and you're learning. Why don't you just put 1? That's the lowest risk you can get, right, in the market. 1 contract. Why do you want me to do 2, Charles? That makes no sense. That's double my risk. Any reason why we might want to do that? And we say 2 minimum. What's our thinking there? That's right. That's right. You can take some profit off when you get a pop in your trend direction, and then you can engage a runner. All right. So let's say that you're filled 2 lot. Let's just go ahead and take that off and say you're filled 2 lot right here. Now let's say that you want to peel off 1 contract after you've hit 10 ticks of movement. So let's see exactly precisely where that might occur. So you're filled at 84.50 short with a 2 contract trade, and then at 83.50 you're going to peel 1 contract, or object trader would put the first 10 tick target and locate it right here. So what that means is that when gold came down and hit and went through this target like such, that it would buy to cover one of your short contracts. So now you'd have 1 left, right? You'd have 1 left. And then so now you wouldn't need 2 contracts on your stop. How many contracts would be on your stop now? Because now you only have 1 contract left here. So contract number 1 comes off right here. Contract number 1, buy to cover at 10 ticks. And we put 2 on, so you got 1 left, right? Contract 1, buy to cover at 10 ticks. So we're out of 1. We started with 2, and now we got 1 left. So what do we do with the 1 that's remaining? Our entry was here. That one's still up 10 ticks. So how much money have we made on this trade so far? How much is gold worth per tick? We have 1 contract short that made 10 ticks. So if I was to put a number in here in terms of money, how much money would we make on contract number 1? Anybody? What's gold worth per tick of movement? GC. Anybody remember? So 1 point, let me help you out. 1 point of movement is $100. That's right. And how many ticks are there per point in gold? 10. Yeah, there's $100 per point. So each point of movement over here from 85 to 86 is $100. So here, let's go ahead and put that in there. Some of you might be new to trading gold, so we can just put it right in here. So $100 per point of movement, right? 10 ticks per point of movement. And so therefore, each tick equals, $10. Right, $10, right? Okay, good. All right, so that's how gold works. So then we see that our first movement of our first contract for 10 ticks, we're taking profit on it here. That means we have locked in $100 worth of profit on our first contract, right? Of profit locked in on what we call our scalp part of our trade, or our initial movement or thrust in the trend or trade direction, which is down in the case of the downtrend, right? So we've made $100. Woohoo! Now, do we still need 2 stops? We only have 1 contract on, right? What do we got to do with our stops? We got to take that down to 1 because we only got 1 contract left. Now, initially, once we get this pop for 10 ticks, what are we going to do? Should we leave our stop way up here? I mean, should it just sit way the heck up here in case it bounces? What do you think? What are we going to do with this stop once this occurs? Once we get this movement in our direction, what do we do with our stop? Do we push it up? Do we bring it down? Do we bring it down here? Where are we going to put it? Any ideas? Anybody? What are we going to do with that stop? We got 1 contract left. We got to do something with it. Initially, you go to, now some of you are saying break even. You can put it at break even, which would put it right on your entry. However, there are a lot of times you're going to see on markets where it will come back and challenge your entry point by a tick or 2, and you don't want to get stopped out before a big run. So we recommend that you go maybe 1 or 2 ticks behind your entry. And so when you have your stop right here, 1 or 2 ticks on that last contract, and you've already locked in 10 ticks, what do we call this? There's a name for this. There is a name for this that we have when we have a condition in a trade that's set up just like this. Anybody have an idea? It's called a free trade. Now you have what's called a free trade. Does that mean it doesn't cost you any commission, that it's free? Does that mean you can go down to the wharf and get free hot dogs? What does free trade mean? Is it free time at the beignet house? We're going to get some free donuts today? Huh? What does that mean, free trade? Well, what it means is that even if this market for some reason just flipped out, plowed right up through here, took your stop out, that you would still net 8 or 9 ticks or $80 or $90 less commission. A free trade means that you cannot lose. There's no more risk in it. You've already made your money. No matter what happens to this market, you have locked in at least $80, $90 of profit with no risk. So what I am describing here, in the way that we took this short, and I explained in detail how we got into it, right? You know, you could have put the sell order up here, put the sell order down here. You could have engulfed it with a region box, closed below to take the short. You could put 2 lots on. You scalp the first contract at 10 ticks. You lock in $100 worth of profit. You take your initial stops. You take it from 2 to 1. You take this down to within 1 or 2 ticks of your entry. Now you have what's called a free trade. If you can manage most or all of your contracts with that kind of money management, I'm not going to sit here and say I guarantee you 100% of the time, but the vast majority of the times you are going to make money consistently. This is what you want. This is the condition you want to get to on almost every trade that you take. Now let's proceed on and talk about what happens to this short and how we continue to manage the trade to work in our favor. Because there's a lot of confusion about this that Gary and I hear all the time, and I think this is a good place to address it. Now, when we talk about trail stops, and I'm going to go through this fairly quickly because I do want to get to some more trade entries, I think, because the topic is trade entries, not trade management, but I think it's important to show this real quick. Now, when the market starts to move precipitously in your favor, as gold did here, what do you do with your trail stops, and how do you manage it when you hear it in the live room? Here was your entry. Close of this bar at 84.50. We know that. We've already peeled one off, so we're only left with one contract. Now, when we say to trail the stop, what does trail the stop mean? How and where and why are we going to trail a stop? What is a trail stop? What are we talking about? Is that like riding a horse on a trail? We're going to take a jog on a trail today? Is it time for like a triathlon? We're going to go jog on a trail? Is this a 10-mile run today? And then we have to ride a bike and then swim? So let me explain what a trail stop is. A trail stop is this. When you have a market that is running in your favor, we call that a runner. And that is where most of your profit is going to be made, in the runners. Now, we have a lot of traders that just scalp all day long. They'll take these 10-tick movements, 10 ticks, 10 ticks, 10 ticks, with a high degree of win rate, as high as 85, 90+%, and they keep their losers tight. And so you can start scalping as many as 5 or 10 contracts at a clip. And if you have a very high win rate, we had a trader, Kitty, that for years did this. She scalped 10 ticks to Tahiti, and she's retired now. But in runners like this, you leave a lot of money on the table. And let me explain what I'm talking about. Can you see this line that is kind of sneaky looking here that's red? That's called stealth. And can you see the red line 2, which is the thin red line that sits just above band number 2? Now we use the combination of these two I'm going to circle them, especially when they intersect like this, as our trail stop. Trailing meaning that you are allowing on the final contract or contracts that you are short, the market to freely move about. What I mean by that is that the market will go down in a thrusting manner in the trend direction, and then it will have shallow retracements like such. And so your P&L will go up, and then it will contract. And then the P&L in the short will go up, and the P&L will contract as the market moves in your favor. You'll be up 100, you'll be up 150, you'll be up 180, and then you'll be up 120, and then you'll be up 200, and then you'll be up, et cetera, et cetera, et cetera, et cetera, all the way down. So the market is moving in your favor. And what you are doing is you are using, I like a combination of stealth and line 2 in the case of the short. And so what in effect is happening is your buy to cover stop is trailing using these tools right here. Market's continuing to move freely about, thrusting and retracing in the direction of your trend, of your trade, which is short. Now, I like to fade line 2 and stealth by fade, meaning that I need to pull back from it a couple of ticks. Here's why. Can you see in the case of the trail stop here on the short with gold that some of the candles just barely wick the stealth line and line 2? And if you had your stop buy to cover stop on that last contract sitting right on it, it would wick you out right here. And you would miss the tail end of the trade as it continued to move in your favor all the way down, like such. Now, if that happens, can you get back in? If you inadvertently get stopped out too early, can you jump right back in? Could you jump back in that trade? Could you re-short it in here? Yes, of course you could. Gold's falling off the map. So it stopped you out. You put another short on and you continue to ride it down. I don't recommend you do that, but you could. Right? You can do that. You can absolutely do that. Well, it's not so much the bar close, Dennis. It's the location of it. Here, let me be clear. Let me blow this up because there's quite a few questions about this that always come in when you say that you fade line 2 by 2 or 3 ticks. What are you talking about, Charles? Okay, so let's be specific about this. In the case of this retracement here, where the market gold went from 80.20, 80.10, all the way up here to 81.30, and as far as 81.50 on this bar right here, that if you had had the trail stop sitting at 81.30, this bar would have stopped you out. Either the wick of that candle, or this candle would have taken your stop out if you were right on line 2. Now, if you were a few ticks above line 2, the wick of this candle would have missed you, right? It would have missed you. So you would have been from 81.30 as much as 81.50 or 81.60, 3 ticks above here on your trail stop. Now, what I'm saying is that if it inadvertently had gotten you right here and taken you out, then when the bar is reversed and started to head back down, you could go ahead and re-enter short and continue the trade on down here or here, or here, re-shorting the market. Okay, let's finish this trade out and then we will be done. So the market continues. You can continue your trail stop. You are trailing, and then, let's say hypothetically it got you out right here. So you buy to cover on your final contract at, let's use a round number, let's use 79. So how much money did you make on this trade, on this gold trade? What was this money? What was this trade worth? Well, you got $100 here. So you already got that locked in. And your second contract went from 84.50 all the way down to 79, which is 15 ticks. No? No, it's more than 15 ticks. 79, 10, 20, 30, 50 ticks. 55 ticks. So the runner made plus 55 ticks times $10 per tick, or $550, plus the scalp, $100, and for a total of $650. That's how much that one gold trade was worth right there. You made $100 on the scalp. You trailed until it got you down here somewhere. So you cleared net about $650 less commission. Now, how many of you would be done trading if you made $650 on a gold short? How many of you would be done? How would you know if you're done? What would be the indication that you were done? Anybody? How do you know if you're done? What is the catalyst to tell us that we are done trading? What do we recommend that you have when you trade each day that will be your indication that you are finished trading? There's a name we have for it. It's a profit goal. That's right. You have to reach your profit goal. Why do we have a profit goal? Anybody have an idea why we have profit goals? Charles S. says, if my wife tells me that it's time to go shopping with my profits, then I know it's time to stop. Well, I'll tell you what. If that works for you guys, then more power to you. To keep the profit and not give it back. We hear this all the time, and for those of you that have traded a lot, you understand what we're talking about when we say this, is that most traders, a lot of traders, and I used to do this myself many, many years ago, is, you get up early in the morning, or you get in whenever you start trading, you start making some money, you get up a little bit or a lot, take some more trades, and then you give it all back. And then you leave the day with a loss. So how do we break that cycle? So what you have to do is you have to have a profit goal. And correspondingly, it doesn't matter. It could be $100. It could be $500. It could be anything. It could be $1,000. It doesn't really matter. Whatever your personal goal is. And you have to have a max stop out loss for the day, right? So those, okay, whatever that is, $200, $600, whatever. You have to, our strong recommendation for long-term successful trading in futures is that you have these numbers sort of locked in. Going into each day, I'm going to try to make at least, $600, and my most loss is going to be $200. And when you hit those numbers, you got to try to respect those. That's how you live a long time in this game. It's the traders that go in and say, well, my goal today is make as much money as possible. You think that's a good idea? Traders who come into each morning and they say this is the last I'm going to say, and we're going to get on to some more trade entries. But this is an important lesson to share. Today's trading, I am going to make as much money as possible. What do you think that's going to lead to? It starts with an O. Okay, I got an O here, and I'm going to put some, what is it going to cause you to do? It starts with an O. Because there's no, all due respect for a trader who takes this approach, there's not normally a lot of discipline. Discipline meaning that our real goal is to take as little trades as possible. Not as many, as little trades as possible. I mean, if you can make your goal in one trade, wouldn't that be ideal from a commission point of view? Right? You're not paying your broker a lot of money. You took one trade and you made your money. You're done. Over trading, that's right. We don't want to overtrade. So at the end of every session, what do we say? What do you always hear me say? Keep your green, don't overtrade. There's a reason I say that. Don't overtrade. It's easy to do. I can tell you from experience, I can remember doing that many, many years ago. Overtrading, it's super easy to do. It really is. You go in there and you got the attitude, this market's going to run 200 ticks and I'm going to get as much as I can. Most days don't go like that, do they? All right, enough comments on the discipline. So, to be successful, obviously, you can see here that it's a combination of things. It's understanding the mechanics and the details of how and where to take trades, getting very, very good at trade entries, picking a good instrument and working on that diligently. Getting yourself to a place where you consistently are able to get free trades, where you take your scalp, you manage your stops correctly, you get that down to 2 ticks for your entry, and then you trail and get those. The runners are where you're going to make most of your money, unless you become a scalper. Set yourself a good realistic profit goal and max stop out loss for the day. Try to get away from this mentality of, I'm going to make as much as possible. You wind up over trading, taking 6, 8, 10, 12, whatever, 20 trades a day. You don't need that to make money. I'm showing you right here, you took one gold trade, you made 650. Most of you typed in the letters that you'd be done. You're at your goal. Okay, enough about discipline. Let's get over to crude oil. Yeah, you should, Dennis. We say that all the time. Let me get in here and get any questions on this. Let's get to crude. I don't see any questions. Okay, I'm going to shift chart. Stand by. It's loading. I'm just trying to be realistic with everybody. I think some of the other things I see is that, I think that, a lot of traders seem to think that, futures trading is just sort of this high stakes, highfalutin, like the old Wild West, sort of gunning for the, gunning for the home run. You're always gunning it. You're like Babe Ruth, 650 home runs, or you strike out 1,300 times. It doesn't have to be like that. You can, if you're a baseball fan or softball fan or whatever, you understand that singles and doubles can win the game, right? You don't need a lot of home runs. Just kind of tap it on the infield there. Keep your losses tight. You don't need to swing for the fences and either get a home run or strike out all the time. Okay, crude's almost loading. Walk away from the computer. We nicely green. Stop the machine or go into sim. That's a good practice time. Okay, hold tight for crude. It's loading. Come on, Crudy. You're killing me. Just to show you, it's kind of locked up a little bit here. Got the gray screen. Just give it a second. Crudy's being a little moody. Okay, let's look for some crude trades. Let's talk about the long side. How many of you like long trades? How many of you can't take short trades? I've talked to a few traders I've seen over the years. Charles, I just can't short the market. I don't know what it is. I always want to buy. I just want to buy. Well, Bernie, the market's not live right now. That's why. It's a static market condition. This isn't. I'm connected to a data feed, but there's no live market data coming in. There's no. So unfortunately, the alerts, you're not going to see the flashing. They should flash. Okay. Well, I don't know what's going on. They don't have the right thing turned on. Let's get crude up here. Stand by. Here we go. Okay. Hold on. Here we go. There we go. Crude. Let's go back to the pit open here on Friday. Okay. Now, unlike some of these other markets, you're going to find contrasting, how would I say it? What would be the best way for me to say this? Not all mid-band trades are created equal. In other words, some markets are going to give you, sort of cleaner, more tighter, more concise trade entries around the minimum trade entry and the mid-band entries, and others are going to be a little choppy. Let's look at some examples here. Here's an example of, let me show you what I would consider to be some good, mid-band boxes and some pretty choppy ones. What makes a good region box? What makes a good trade entry? What makes a good mid-band trade? Well, let's look at some examples of good ones, marginal ones, and choppy ones. Right here, for instance, you can see that when the market came up and kissed and rolled off of here, now this would have been in the pre-market before the pit opened on crude, you got a fairly tight box. So when we talk about trade entries, we really want to see a box that is usually under 10 ticks. So here you got 63.60, and the bottom's at 63.53. So 7 ticks. 7, 8, 9, 10 ticks is a good box. That's a good size region box. Here, for instance, over here, this box is a little bit larger. Can you see these candles forming right here like this? So the bottom of the box would have sat at 63.14, and the top of the box would have been here at 63.25. So you're right at 10 ticks. This is kind of a marginal top-end large box. You don't want to get boxes too much bigger than this. In the case of the long trade, you would have been filled long on one of these bars right here that closed outside of the box. Or if you'd put a limit buy order in, you would have been filled long there. Let's look at some other boxes that are marginal. How about this one right here? How do we feel about this box right here? Well, the top of it is located roughly at 63.39, and the bottom's down here at 63.24. How do we feel about this one? This is 15 ticks. 15 ticks from here to here. Top of the box to the bottom of it. How do we feel about this box? Is this too big? In terms of taking a trade, is that box a little too big? Let's contrast the size of this box with the size of this box and the size of that one. This one. What do you think? What, in your opinion, would be the largest size box that you should put on without getting yourself into what we call breakout trading? Think of it like a coiled spring. Isn't a region box at the midband kind of like coiling up a spring that's ready to kind of bounce and expand? So if you think of it in that way, the tighter the box at the midband, the better, right? Because the compression is building here for a much larger move, which in the case of the short here turned out to be that pop right there, right? In the case of the long trade, here we have 8, 9, 10, we're 10 ticks, and then we get a nice pop to the upside. Now let's look at this box over here. Here's a 15 tick box, really large. You broke out, maybe you were filled short on the close of this bar right here, outside of your box. But then you felt some heat as it pulled against you, right? And did you get much of a move out of it? What kind of move did we get out of here? Not so much. So what you find is that, and this is not, I'm just not singling out crude. Don't get me wrong. I'm not disparaging crude as an instrument. That's not what I'm saying. I'm saying you have to trade crude on the methodology the same that you trade everything else. It's all the same. The trading entries, the thinking, the trail stop, everything is the same. The difference is that you want to keep your box, these entries at the midband at or less than 10 ticks in size. Ideally, a tight box that's maybe 5, 6, 7, 8 ticks. This is a good ideal box. This is pushing the top end of a region box entry, and this is just too large because you have basically a breakout trade, and we try to avoid those. Okay, let's look at some other trade entries. Let's see if you can spot a couple. Let's do a quick exercise together on crude. You ready? Come on, let's do a couple exercises on crude, and you tell me when you think you see a trade entry. And let me give you a couple easy ones, and let me give you a hard one, okay? Let's do this. Let me see if I can find a couple for you real quick, and then we'll wrap up. Let's do a quick exercise together. Yeah, let me give you a couple easy ones, and then I'm going to lob a couple real hard ones at you. You ready? Now, I'm going to do this. When you think you see a trade, if you think it's a long trade, please type in the letter L. I'm going to advance this chart as if we're watching it in real time together on crude. And then when you think you see a long trade, you would type in an L. And when you think you see a short trade, you would type in the letter S. Are you ready? Okay, now don't type anything in yet because we're just going to start the exercise. We're going to do a few of these together. Here is, so let's see, 5:16. This is midnight Pacific. I'm here in California, so it's all Pacific time right here. And here is 3:22. So we're starting our exercise here. Here we go on crude. Now remember, if you think you see a long trade, you type in the letter L. If you think you see a short trade entry, you would type in the letter S. Here we're at 4:24 a.m. Pacific on the morning of the 16th. It's 5 o'clock, 5:09. Crude oil, 16th, 5:30, 5:37. 5:59, coming up on 6 a.m. That's a crude pit open. Morning of the 16th, 6:09. Okay, here we're at 6:23. So we're at a little over 20 minutes into the crude oil pit open, CL, morning of the 16th. We blow it up so the chart bars are a little bit larger. You can see them a little bit better. Okay, now we're at 6:21. 22 minutes into the trading session on the crude pit open. There's 6:24. Remember, you're looking for long or short trades that would be located at or around the mid-band. That's the purpose of the exercise. When you think you see one, you type in an L for long, S for short. Continuing onward, 6:25. See, the 16th would have been Thursday morning, right? Okay, 6:31, 6:35, 6:42. Okay, I'm going to stop it right there. Now that you have a chance to see the entirety of the bars, can everybody see where the trade's set up? Would you not agree? And we still have a lot of people in here today, so welcome everybody, especially late birds. Don't worry, everybody gets a recording of this. So I see people left early, and a lot of people came in late. Don't worry about it. Now that you have the benefit of hindsight, would you not agree, everybody here, that in terms of a mid-band trade, we have these bars here, just under the mid-band, right? We have these bars here, which are sitting right on it. And we have these bars here that are sitting in the band slightly above the mid-band. And would we not have engulfed this area with the region box enabling long only? So let's go back, recreate this trade real quick. We can see right here that the direction of the thrust was up. So we are in an uptrend with a green background. Bars are predominantly blue. Mid-band and all the bands above and below it are stair-stepping up. We are looking for longs. So when you typed in a trade, the entry would be L for long, right? We were looking for retracements to the mid-band to get in. And sure enough, after this thrust up here to 63.20, we get a pull back into the mid-band located right here. So this is a long trade on crude entry at the mid-band. Everybody see that? Now, after this entry here, was there another chance to get in? If you missed this. If you missed this long entry here on this retracement, was there another chance to take a long trade on crude after this one occurred? Anybody? This would have been right around here. Let me get the cursor on here. Yes or no? What do you think? Was there another spot This one's set up at around 6:23, well, just before 6:30. So crude pit opens here at 6. Gary opens the room at 5:45, 5:55. So on this particular morning, the live trading room would have been open somewhere around in here. Gary opens it up watching crude for moves, right? Now just a side note here. A few of you typed in longs. Now, you obviously didn't want to take long trades up here. This is the apex of the thrust in an uptrending move, right? Remember, we don't trade thrusts. We don't get in at the apex of thrusts. We have to wait for pullbacks to get in our trades, right? Yes, right. So did this trade get a scalp off? Sure. Didn't quite get to the top, but you get another pullback here. Is this another trade entry at the midband? What do you think? How about right here? How's that look? Are those bars around the midband anywhere? Yeah. Are they sitting right on it? Yep. 635, 636, 640-ish. Depending on your location of your region box or your limit buy order. No shorts, long only, right? Long on that bar or long on that bar right there. Pop up, get your scalp off. Remember our 2-lot free trade? Remember that? Remember our 2-lot free trade? Here's your scalp. Get your 10 ticks. 10 times 10 is 100. Now you get $100 on your crude. Now here you wouldn't want to put your, remember we said you're going to take your second contract, 2 ticks behind your entry. You're filled long here. We see the reason for that, right? Here's that pullback I was telling you about, remember? Get your scalp off, then a pullback. And then we engage our runner for the trail, right? So here goes the trail. You know, maybe it stopped you out here. You re-entered. Here's some more trade entries here, depending on how loose your stop was. I don't know. In and out. Let's say you wrote it up to here. How much was this crude trade worth? 10 ticks on the pop. And let's say you got a chunk of the runner that got you to here. So let's do some quick math. Long at 63.01. 10 ticks would have been 63.11. Actually, that would have been right here. You would have been take your scalp off right there. Did we take that trade? I think we did, Bernie. Do you remember that morning? You called and we took that trade. I remember that. Yeah, I think we did. This was Thursday morning, right? 17th, 18th? Yeah, this would have been Thursday morning. I don't know. Maybe you got out at 50, 55-ish on the stop. 54 ticks, 540 plus 10, $640. Yeah. 10 ticks on the pop, $100, $10 per tick times 54 ticks, 540 plus 100, $640. Yeah. So that was done. That was all done by, you got into it around 6:30-ish. And then you were all done by, well, before 8 o'clock. So hour and a half, $640. Could you have stopped out and re-entry here on a minimum criteria? If you didn't catch it, could you have caught the tail end of it if you missed the initial entry? Yeah, of course. Yeah, that was good. That was a good retracement. You caught maybe, half of it, maybe 25 ticks. Second half of the move off that retracement right there. All right, I'm running a little bit over here. I'm going to go ahead and stop. I'll continue this next week.